some of the banks, specifically the ones that have a good amount of growth, I think have been neglected over the past few years, ever since the first Republican Silicon Valley Bank sort of debacle that happened. And so I think some of the growth investors that were investing in those banks have basically said that they're now no longer interested or looking at banks. And I think what that's created is an interesting opportunity in banks that have growth opportunities. They do need to be offset, though, with the issues that happen with those banks, specifically things associated with, too much leverage, the mismatching of assets and liabilities from a duration perspective. And it wasn't as much, but credit issues also. Those are, I guess, more of the danger point in banks. But there are ways to basically mitigate those. Part of it is looking at the specific metrics, but what's more important is the management teams and the ability and their track records historically of setting the culture of making sure that the underwriting culture is strong and that the loans will perform and that basically they've reserved enough for those loans. And also from a asset liability perspective to make sure that they haven't mismatched their assets and liabilities. I mean, most of the banks we'll be looking at today have a tendency to be asset sensitive. So those banks have done relatively well on a performance perspective over the past few years. But what's lagged has been their stock performance just because of the overall, lagging of banks versus other sectors in the market. So initially here we've got this is a disclaimer. This is not investment advice, and this is for entertainment purposes only. Just the typical disclaimer. So we'll sort of start out here initially. Thought it would be good just to provide a little bit of historical perspective here in terms of some of the banking trends over time and how we got to where we are now with banks. Now, banks have a storied history. I mean, they go back to the beginning of the Republic back in 1776. So some of the banks have been around for a long time. Many of them have been founded in the 1800s. But what's happened recently, I think two of the big trends, and we'll talk about it here, that have really driven banks and just the case or the thesis for banks have been deregulation over time. And the important acts that have happened in the past have primarily been the Regal-Neal Interstate Banking and Branch Efficiency Act of 1994. Before that, banks basically could only bank out of one branch. There was not, you couldn't have more than, a few branches in each state. And what this did is this allowed banks to have multiple branches and allowed consolidation activity. And then there was the Graham-Leachy Bill of 1999. What that did, historically, banks were focused primarily on commercial banking activities and weren't allowed to do investment banking and brokerage. This particular act or law basically allowed banks to get back into investment banking and brokerage. So what the banks had done historically is, okay, they started out, there was the first bank of the United States, then there were state banks, and then and banks just grew. And then what happened was during the Depression, there was a consolidation of a lot of the sort of banking activities, and there was a lot of regulation that happened, including the the law that separated investment banks from commercial banks. And then after that, since then there's been some deregulation. The banks were all broken out, and the history is the United States historically has had a lot of small banks, and then now we're in a process of where there's consolidation in the banking industry, and that's creating some interesting opportunities. And then after the Graham-Leachy bill in 2010, there was a Wall Street Reform and Consumer Protection Act. And basically, what this did, as a result of 2008, it basically said banks had to have stress tests if they were considered too big to fail. And so, again, this is another evolution in sort of the banking process over time. The net effect of these deregulatory acts is banks have gone down quite a bit. In the mid 80s, there were around 14,500 banks. Now there's only 4,000. And there's continuing activity in terms of consolidation today. Now, what's happened with some of the bigger banks, there's certain limits on how much deposits they can have. So there's some growth constraints there on some of the bigger banks, but some of the smaller banks and the mid-sized banks, they continue to have nice growth runways. And the ones that we're looking at are primarily in those areas where the growth runways are still quite large and probably can continue to for at least 10 to 20 years. Some interesting ways that people have been able to generate value buying bank stocks over the past, I would say the biggest thing is probably over the past 20 years, starting in the 1990s with the deregulation, which has created this opportunity, has been demutualizations. These are situations where you had savings banks that were mutually owned, and over a process, they would become stock owned. And initially, what had happened was that depositors in the banks would get the first cut at being able to become shareholders. So you had a number of investors in the 90s and 00s that basically had small deposits in banks around the country to basically take advantage of this phenomena. Even though this continues on, it's at a much slower pace than what it used to be. And so that's one area. The second area, which is a set of U.S. Treasury incentive programs. The Treasury has set up a series of incentive programs to encourage banks to lend to in low income communities. And what this really comes in the form of is either new market tax credits or capital market fund credits. And what that does is it basically provides credits to allow basically provides leverage or credits for low income communities and makes these projects from an equity and from a banking perspective much more favorable for people to lend into. There's also the ESIP program in 2022, which basically provided some of the same institutions that were doing the lendings for these treasury programs, low cost funds ranging from 0 to 2% preferred stock they were provided. And again, it provided a way for the government to incentivize and basically lever up these institutions, taking advantage of low interest rates to basically make them economically more enticing for bank investors and other investors to basically invest in these communities. And there's other programs too. The other way over time, as a result of sort of the deregulation, is consolidation over time. So if you take a look at the banks that are large now, they've pretty much done that by buying other banks and buying other banks over time, and either in stress situations, which happened in 2008 in a number of cases, or in non-stress situations, which happened in non-stressful times. And then one last trend, I think that's an important trend that's happening now, is there's banking as a service. Now, what this is that a lot of fintechs out there are not banks, and they don't have the ability to deal with the regulatory issues of banking. So what's happened is there's been a collection of banks that have basically provided the banking back end to fintech. And this is definitely a growing area. And it's an area where now there's been some weeding out in that particular industry, because you've had some banks that have tried to do it and have run into regulatory issues. And there's probably, I would say, a half dozen banks that do a really good job at this and have a good amount of experience. And so what they really get as a result of this is you generate a lot of non-interest or fee income, and they also get some net interest income with some risk sharing for some of these partners too. So it's a really interesting sort of opportunity. I think it's a growth area in banking, and that's we're talking about banking and growth. I think that's why I bring it up here. So if we go to the sort of the criteria that I've sort of have used to select what I think are sort of banks that are growing. Usually the banks that we're looking at today and the ones that I'm really looking for are banks that are growing 15 to 20% plus per year and probably selling for high single digit multiples. I think that combination of returns over time results in a really nice sort of return for investors if things don't go wrong. So again, this is always in a sense of taking a look at the downside, and you'll see that in some of the criteria here of looking at bad non-performing assets and coverage to asset ratios to make sure those are adequate, so that there's not any surprises per se that could upset this. So basically what I'm looking for are banks that are generating, these are sort of ideal criteria: 1.5% on assets, 15% return on equity. Many of them, as we will discuss them today, have higher numbers along those lines. You want growth lending So you want to be able to at least be able to get mid-teens net income growth as a result of this. And the banks we talk about today, there's one that's got dividends, but most of them retain most of their earnings because of the growth potential that they have in their underlying markets. Um, Target less than 3% non-performing assets, and that's one of the safety things. And adequate reserve ratios, like to see NPA to reserves of about 150%. So that means that the amount of reserves the bank has set aside is 1.5 times the amount of non-performing assets. And usually what happens with the non-performing assets is you do get some recovery. So in essence, you do have a good size of margin of safety there. That's where I think the margin of safety of these banks. The other thing is to take a look at most of the banks that we have here are asset sensitive banks, meaning that their assets are going to go up as interest rates go up. Because another issue which happened with Silicon Valley and some of the other banks is that if you invest in assets, fixed assets, you invest in banks that invest in securities that have low yielding in your short term, because banks in essence are lending long and borrowing or borrowing, getting deposits, paying short term interest. That balance can come unbalanced when the bank buys a fixed rate security, and then what happens is interest rates go up and they're funding it with low cost variable rate securities. At the time they bought them, those were low, but if those increase, then that creates stress, and those are the kind of situations that we try to avoid. And in the banks that we're looking at, they're not in that situation. And then the other thing I think that's important, and this is just more of an observation, is that, and you'll see it in each one of these banks, but usually what will happen, which will generate these high returns on equity and assets, is there's some kind of a niche non-interest income services. So these things can include things like transaction processing, which creates float. Um, and then you've got SBA loans, the treasury programs, as we had mentioned before, which for the treasury programs, you both get fees, plus you'll be able to generate loan demand for those. And some of the loans have loan guarantees, and there's all kinds of nice incentives along those lines. And then banking as a service, as we had mentioned. So I think those are the main sort of non-interest income services that you can see in sort of these faster growing banks. The key thing, another thing that we look for is the first up next behind high return on equity and assets, and then the ratios that sort of would pretend for those going forward and that could be repeatable is sort of capital allocation. We've come up with a metric to measure the return on incremental equity capital, and we'd like to see that number being at least 20%. So one of the key metrics in banking is looking at returns on equity. And there's a way, and we'll go through it specifically here to say, okay, well, here's if you look at the change in equity and the change in net income, that'll tell you which way is the return on equity going. Is it increasing, decreasing? And we'd like to see situations where the incremental return on equity is at least 20%. If we're buying something that's got a return on equity in the mid-teens, and it's the 20% or higher, that means that return on equities can continue to go up if the trends continue the way they have in the past. We like to see bank buyback stock. The way we look at buybacks is we want to be able to get mid-teens returns on forward valuations, because the thing about stock buybacks, what's important, at least in my opinion, is if you can estimate what the forward valuation is, buying back stock, that's what you really want to take a look at. Because if you buy back stock today, you're in essence buying back tomorrow's earnings at today's price. So in essence, that's the way that I think buybacks should be looked at from a capital allocation perspective. And then finally, consolidation. There's local and service synergies over time. So as these banks, if they've got, local areas where they're at, they can get synergies in terms of from a geography perspective, and then also from a service perspective in terms of providing more than one service to one particular client. Now, in the end, we want to get these available at a reasonable price. Our sort of goal there is 40%, which is a combination of EPS yield and growth. And you'll see in the examples that we have here, they're in the high 30s. And that's a lot, part of that's due to the recent increases in some of the prices, but I think that's more than adequate to basically get a decent return on these stocks. Because if you look at them, if you got a stock that's growing 15 to 20% return, you're getting a high single digit return. You probably can get at least a double on the valuation and the valuation multiple if the growth is there, and the growth probably can go up 2 to 2.5 times. You're talking about a 4 to 5 times over 5 years, which I think is an adequate sort of expected return for a number of these names. So if you take a look at banks, these are sort of areas that I've seen in the past that are sort of like I describe them as stories, but these are sort of the narratives of banks that have had higher than normal, I would say, returns on equity and have been able to generate the 15 to 20% returns on equity over time. Some of them include processing. So processing basically provides two things. It provides fees, so these would be like, for example, debit processing and or credit card processing. And then in addition, you get the float, and the float is usually a low cost of funds. So you really get a double, double good things here when it comes to processing, because you can use the processing fee as float to offset any additional, let's say, capital requirements that you need for new loans. This is actually providing a source of funds as opposed to a use of funds to grow. Another sort of area is brokerage, asset management, and custody fees. There's some banks that have sort of focused on this. Now today in processing, we're looking at a bank called FFB Bancorp. They've used processing in sort of that way. The challenge for processing is trying to get processing as a larger percentage of the business of the bank. Most banks do processing, but it's a relatively small portion of their overall sort of book of business that they're doing. Brokerage is another one, like saying there's a company called Axos Bank that has sort of done this in an interesting way where they've been able to generate growth. There's also another bank. I think we get another way to do this is buying what I describe as orphan loans. These are loans that banks basically are forced to divest either because of M&A, usually when there's a merger and acquisition and there's overlapping territories. The banks are forced to get rid of a set of loans, so they don't so basically they basically end up with a competing bank in a specific geographic area. And the other area is when there's distress. So this happened when for example, Silicon Valley Bank loans were sold to First Citizens. And so this happens in those two cases. In the case where it's the distress, that's more aperiodic. In terms of M&A, that's sort of a constant flow of loans. And one of the banks we're talking about today, that's sort of like what they do. So that can create some good growth over time.